Hi, Matt McAleer, Cumberland Advisors, Director of Equity Strategies, May 14th. Fun week, a lot of volatility this week. A lot of headlines in terms of economic news. A lot of action in equities. Saw some severe volatility in some of the more popular names last year, some of the best performers, be it software or stay-at-home stocks, solar energy. Saw a lot of real pressure. We did do some trading in the accounts this week. For example, on Wednesday, as the Dow pulled back into a really nice area that it's found support in March, and Thursday, that was a position added to the tactical portfolio. Brought us down to 12% cash. Comfortable there in our tactical trend. Remember, we took down Qs a month ago as they were making highs. Raised some cash. Now we're looking to put that back to work. Added to the Dow, which has been a stronger performer than both the S&P and the NASDAQ. Wednesday, we also had enough downside volatility and a touch of panic in the markets to create a buy signal in our quant work. Dr. Chen tracks our analytics through options, through sentiment, through a number of different areas. We did get a buy signal at the close on Wednesday. What does that mean for clients? Clients that are in the quant strategy are now fully invested. When we're on a buy signal, we're 100% the S&P 500. In our U.S. portfolio, we also take that 10% cash we had raised back in April and put it back into the market. Remember what that quant signal is meant to do. It's meant to just give us a little guidance to be fully invested, looking to take advantage of growth and upward volatility in the market, and or get a little defensive and dampen upon an exit. So back the first week in April, when we did have our sell signal, we raised some cash in the portfolios. Now that money is back fully invested in the U.S. portfolio. In addition to that, remember, when we get a buy signal, we do a rotation inside the U.S. portfolio from defensive or low beta names, such as staples and utilities, to higher beta or aggressive names, technology, energy. So you see those changes in the portfolio. We also had another trade within the portfolio, just adding to TAN, the solar names on that pullback we've seen over the last 60 days. Remember, that was a trade we put on last year, treated us very well. Started buying that in the 35 to 40 area, ran to well up over 100, got to be 2x the size that we were comfortable with allocation-wise in the portfolio. We took it back down to its original 5% size. We've now added another percent to TAN. We're in the 6-7% area there. We're comfortable at that $70 level where we added back in. Let some go in the 115, 120 area, added back in here. Some very interesting names there. Some of our oversold momentum work is showing that we could have cleared out enough of that late money, those late holders that came into that trade in December, January, February, may have cleaned them out. See if we can get some further upside next week. So that's what we're doing on the equity side. Interesting, though, that when we look at what worked this week as a whole, not just on Friday and Thursday, it was still your defensive type of names. Dow was the best U.S. performer, down just 1%. When we look internationally, EFA, or developed Europe, down just 1%. This week. Emerging markets down 3%. So you're starting, I shouldn't say you're starting, we're continuing to see a bid into developed markets internationally and broader basic materials, industrials, banks, energy, traditional energy in the U.S. Markets. Let's see what next week brings. Again, U.S. portfolio fully invested. Tactical trend, has about 10, 11, 12% cash to work with. And then our quant trading portfolio, fully invested. International has about 5% cash to work with. Remember, volatility creates opportunities. We like volatility. It will create opportunities for us. We'll look to get some of that cash to work at reasonable levels. Have a great weekend.
Good morning. It's John Mousseau. I'm the CEO and Director of Fixed Income at Cumberland Advisors. It's Friday morning on May 14th. I'm off today, but I wanted to say a few words on the fixed income markets because we had quite a week in fixed income from a volatility standpoint. You look at the 10-year bond, started the week at a 157. It's ending up at a 163, hit as high as a 170. The 30-year bond started the week at a 228. It's about a 235 now. That got up as high as a 240. What was the volatility this week? We have a couple of charts showing you the CPI numbers, X food and energy. We have month over month, and we have year over year. As you've heard me talk, we really don't pay that much attention to the year over year numbers because we know that we are replacing negative numbers from last year with positive monthly numbers from this year. The month to month numbers we do care about a lot. And that was a big jump this week when you look at a 0.9 number on monthly CPI, ex food and energy. Monthly PPI, producer price index, ex food and energy, was 0.7. So much higher numbers. Just for a point of factuals, just multiply those by 12 and you get the kind of possible forward-looking numbers we're talking about. It's not going to be that. We're in this transitory time period right now where we're coming out of the pandemic. Price pressures are out there. We see that, and I don't mean just the gasoline because of the shutdown of the pipeline. I also mean everything else from trying to book cruises to airlines next time at holiday season this year. All of that, we can see the pressures ourselves. Some of that's going to be transitory as some of the supply chain disruptions take care of themselves over time as things continue to get back to normal. The question is that for how long and how many months in a row are we going to print higher numbers? When you look at the year-over-year CPI numbers, which we said don't mean much, the one thing that you know is if you continue to keep that number higher and volatile, you know that we're well behind with where the 10-year bond is right now at a 163. So we think that what happens to the balance of the year is you creep yields higher slowly over time, and it's another sign of return to normalcy. The real question will be, is this month over month jump transitory, and for how long? We do think it's transitory. We do think it's a little longer than most people think. It doesn't just go away because there's lots of different sections of the economy that are recovering at different paces. And one of the big differences now versus the last 15 years, which we're used to, is the fact that for the first time, many suppliers of goods and services have pricing power that they haven't had before. So previously, people were very reluctant to raise prices because they would lose market share. That fear is not there now, and you're seeing price increases. And the question will be how long. So we will watch it. We're going to continue to watch the volatility in the bond market. One of the real questions will be, is the bond market subject going forward to the volatility of these numbers? Because we think the inflation numbers remain volatile. The question is the reaction of the market to those numbers on an upward path? And that's what we'll be watching. Have a great weekend. Thanks.